For centuries, the global financial system has been portrayed as a complex, evolving structure shaped by innovation, competition, and the natural forces of capitalism. But beneath the polished surface of this narrative lies a much older, far more intentional design, one built not for the prosperity of the many, but for the consolidation of power in the hands of a select few. The official story tells us that wealth is earned, that opportunity is abundant, and that markets reward merit. Yet as economic cycles repeat, recessions deepen, and inequality widens, a different, more disturbing truth begins to surface. What if the global economy did not evolve organically at all? What if it was engineered? Consider the staggering fact that 12 families control roughly 80% of global wealth. This is not a random distribution of fortune or a byproduct of free markets. It is the result of centuries of financial positioning, political influence, and strategic manipulation of debt. History shows us that power does not simply accumulate. It is constructed, it is preserved, it is inherited, and the world's wealthiest families have excelled at building systems that guarantee their dominance long after individual empires, governments, and currencies have risen and fallen. But this revelation forces us to confront a deeper question. If capitalism promises upward mobility, why do the same bloodlines remain at the top generation after generation? If markets reward competition, why do monopolies governed by elite families persist across centuries? The reality is that while the average person experiences capitalism as a struggle for survival, the financial elite experience it as a mechanism of control, one they helped design. Before we go further, let me know where you're watching from in the comments, and subscribe if you want more unfiltered truth, because today, we are peeling back the layers of a system older than most nations, stronger than any government, and more profitable than any empire. To understand the origin of this wealth concentration, we must return to the 17th and 18th centuries, a time when Europe was defined by war, monarchy, and political upheaval. Money was the fuel of every conflict, and when kings ran out of it, they turned not to their citizens but to private bankers. These early financiers established a pattern that continues to this day. Governments depend on lenders far more than lenders depend on governments, and whoever controls credit controls nations. This dynamic birthed the first central banks, the most notable being the Bank of England in 1694. Although it served the crown, it was privately owned, allowing wealthy investors to profit from the debt of the state. This was the birth of a new kind of power, one rooted not in land or armies, but in credit. And families who mastered this system became the architects of the modern world. As the concept of privately controlled national debt took hold, a new class of power brokers emerged, families whose wealth was measured not by land or title, but by influence over the very lifeblood of nations. Among them, none rose more rapidly or strategically than the Rothschild family. In the late 18th and early 19th centuries, Mayer Amschel Rothschild devised a plan that was revolutionary for its time. Instead of concentrating financial operations in one location, he placed each of his 5 sons in separate European capitals: London, Paris, Frankfurt, Vienna, and Naples. This decentralized but coordinated network gave the family unparalleled access to intelligence, currency flows, and political shifts across the continent. Where governments relied on slow couriers and uncertain communications, the Rothschilds built their own private network of messengers, vastly outperforming the information infrastructure of established empires. During the Napoleonic Wars, this advantage became a decisive factor in their rise. While kings and generals struggled to determine the outcome of the Battle of Waterloo, the Rothschilds already knew the result and positioned themselves to profit from the impending shift in financial markets. This single example illustrates the deeper truth of global finance: information is power, and those who control it shape history. The family's growing influence extended far beyond wartime speculation. They financed roads, railways, and industrial expansions that propelled Europe into the modern age. Their loans stabilized faltering governments, rescued collapsing banks, and even determined the political fate of entire nations. But their operations were not isolated. They intersected with other powerful families, from the Warburgs to the Oppenheimers, forming a network of elite financiers whose impact on global development was immeasurable. Across the Atlantic, America was experiencing its own transformation. As the Industrial Revolution swept across the nation, families such as the Rockefellers, Morgans, and Carnegies emerged as titans of oil, railroads, and steel. These were not merely businessmen, they were architects of industry, orchestrating mergers, crushing competition, and creating monopolies that placed entire sectors of the economy under their control. Their influence seeped into every corner of American life, from transportation and energy to education and politics. By the early 20th century, the unchecked power of these families became a defining feature of American capitalism. The line between private enterprise and public policy grew increasingly blurred. Corporate boardrooms became unofficial branches of government, and financial elites held sway over decisions that shaped the direction of the nation. It was in this environment that one of the most consequential events in financial history took place: the creation of the Federal Reserve in 1913. Although framed as a necessary reform to stabilize the economy, the Federal Reserve was conceived behind closed doors by a small circle of powerful bankers and politicians at a secretive meeting on Jekyll Island, Georgia. Its structure reflected their interest. 12 regional banks controlled by private shareholders, with a central governing board that operated independently of direct political oversight. In effect, the Fed became a hybrid institution, public in appearance, but heavily influenced by private banking power. The significance of this structure cannot be overstated. By gaining the authority to issue currency, set interest rates, and control the nation's monetary supply, the Federal Reserve became the most powerful financial institution in the United States. And the people who shaped it were connected directly or indirectly to the same elite families who had been steering global finance for generations. Their control was no longer confined to Europe. It now extended across the Atlantic, embedding itself into the economic foundations of the world's emerging superpower. The patterns were unmistakable. Whether in Europe or America, the same mechanism repeated. Private financiers gained influence over national debt, shaped monetary policy, and positioned themselves as indispensable to governments. In doing so, they achieved a level of power that transcended political cycles and outlasted the rise and fall of empires. But this was only the beginning. The true mechanism that allowed these families to consolidate control, one that operates invisibly through global debt markets, central banking cooperation, and international financial settlements, was still emerging. It would transform not only nations, but the entire world economy. By the early 20th century, the financial world had entered a new phase, one defined not simply by wealth, but by structure. The institutions created during this period did not merely facilitate economic activity, they shaped it, determined its direction, and set the boundaries within which governments, corporations, and individuals could operate. Chief among these institutions was the rise of central banking networks, which united national economies under a shared framework of debt, liquidity, and monetary policy. But behind these banks, supposedly independent official bodies tasked with stabilizing economies, stood the same families who had mastered the art of private finance centuries earlier. The creation of the Federal Reserve was not an isolated development. It mirrored a broader global trend. Nations around the world established central banks modeled on similar principles: independence from democratic oversight, control over interest rates, and the authority to regulate money itself. Although these central banks were portrayed as neutral, technocratic institutions, their origins and policy decisions bore the unmistakable imprint of elite influence. The shift from commodity-backed money to fiat currency, for example, was celebrated as a modern innovation. Yet in practical terms, it gave central banks, and by extension, the private banking families who shaped their policies, the unprecedented power to create money out of nothing. This transition fundamentally altered the nature of wealth. No longer limited by the scarcity of gold or silver, money became an abstraction, conjured through loans and sustained by trust. Governments, corporations, and individuals were suddenly able to borrow far more than they could ever physically repay. This explosion of credit built towering financial empires, but it also wove nations into an intricate web of obligations, controlled by those who managed the flow of liquidity. Under the system, debt ceased to be a burden, it became a tool of control. The Bank for International Settlements (BIS), established in 1930, served as the culmination of this global transformation. Founded ostensibly to facilitate reparations after World War I, the BIS quickly evolved into something much more significant. Located in Basel, Switzerland, the BIS operates with complete legal immunity. Its property cannot be searched or seized, and its workers cannot be prosecuted under ordinary law. It is the central bank of central banks, a hub where monetary leaders meet behind closed doors to coordinate global financial policy. The general public remains unaware of these meetings, yet the decisions made there influence interest rates, liquidity flows, and the stability of currencies around the world. To this day, the BIS remains exempt from taxation, regulation, and oversight by any government. This level of secrecy and autonomy did not arise by accident. It reflects the priorities of those who helped shape its formation, families and institutions whose power transcends national borders. While official narratives emphasize cooperation and economic stability, the underlying structure reveals a different motive: persistent, intergenerational control. Central banks, though nominally public institutions, function within a framework influenced by private interest, historical alliances, and inherited wealth. Their decisions often benefit financial elites long before they reach the broader population. When markets crash, bailout packages preserve banking institutions while homeowners lose their properties. When interest rates rise, borrowers suffer while lenders profit. When national debt balloons, financial institutions benefit from the guaranteed interest payments extracted from taxpayers. This pattern reflects the deeper truth of the financial world. The system is not designed to be neutral. It is designed to preserve the power of those who created it. The consolidation of wealth among 12 families is not simply the result of inheritance or business success. It is the natural outcome of a system where money is produced as debt, where credit expands relentlessly, and where the institutions that govern this expansion are shaped by elite interests. In such a system, wealth gravitates upward. It accumulates in the hands of those who control credit, information, and policy. The divide between the wealthy and the rest of society does not reflect a failure of capitalism. It reflects its intended function. The mechanism becomes even more evident when we examine the role of international lending and global financial institutions. Organizations like the International Monetary Fund (IMF) and the World Bank operate under the guise of promoting global development. In practice, however, their loans often saddle developing nations with unsustainable debt. In exchange for financial assistance, these institutions impose conditions: privatization, austerity, deregulation that disproportionately benefit multinational corporations and financial elites. This process, known as structural adjustment, effectively transforms sovereign nations into economic dependencies. Through these institutions, the same elite families extend their influence across the world. Nations become clients, economies become leverage points, resources become bargaining chips. The financial elite do not need to govern nations directly. They govern through economic obligation. And yet, despite the overwhelming evidence of this structure, the true mechanism behind the consolidation of global wealth remains largely invisible to the public. It is embedded not in laws or elections, but in the architecture of finance itself. To understand how this mechanism works and why it is nearly impossible to escape, we must examine the core financial system that binds nations and individuals into perpetual dependence. What you discover next will fundamentally change your understanding of money. To grasp the mechanism that allows a small network of elite families to maintain dominance over the global economy, one must understand how modern money is truly created and why this process inherently concentrates wealth at the top. At the center of this system lies fractional reserve banking, a method that allows financial institutions to lend out far more money than they actually possess. While this process is often described as a mundane component of banking, its implications are profound. It enables banks to create money out of thin air, expanding credit far beyond the physical assets they hold. For the average person, money must be earned through labor, investment, or trade. For financial institutions, money is produced simply by issuing loans. This distinction creates a hierarchy within the financial system. Those who lend control the creation of money, while those who borrow become bound to it. Every dollar issued as a loan returns to the lender with interest, ensuring that wealth flows upward over time. As long as borrowers continue to rely on credit, whether households, corporations, or governments, the financial elite continue to accumulate wealth. This is not a flaw in the system, it is the design. Consider the scale. According to recent estimates, over 92% of global money exists only as digital credit, not physical currency. It is created through lending, not minting. When an individual takes out a mortgage, the bank does not hand over existing money. It creates new money by entering a number into an account. In effect, the bank expands the money supply at will. But because the borrower must repay that amount with interest, the system generates perpetual demand for more money. This dynamic ensures that debt grows faster than the supply of money to repay it, forcing individuals and governments to take on new loans to service old ones. This cycle of debt is the engine of elite power, because the families and institutions that control major banks also influence monetary policy at national and global levels. They operate within a system that guarantees their profits while shifting risks onto society. During financial crises, governments often bail out banks to prevent systemic collapse. Yet the individuals who benefit most from these bailouts face no consequences. After the 2008 crisis, for example, while millions lost their homes and savings, major financial institutions received government support totaling over $700 billion through programs like TARP. Meanwhile, the executives at those institutions continued to receive bonuses and compensation packages worth millions. This pattern reflects the principle of privatized gains and socialized losses, where profits flow to the elite while the public bears the cost of failure. It represents a moral hazard at the center of global finance. One that disproportionately harms ordinary people while rewarding those with power and influence. Another critical mechanism in the consolidation of wealth is the international settlement system, which facilitates financial transactions between nations. At the heart of this network is the Bank for International Settlements (BIS), an institution immune from oversight, transparency, and legal accountability. The BIS coordinates policies among central banks worldwide, ensuring that monetary systems operate in harmony. But this coordination also ensures that the interests of elite banking families remain protected. Decisions made within the BIS regarding interest rates, liquidity, and financial regulation shape the global economy in ways the general public cannot perceive. The BIS is not subject to the laws of the nations in which it operates. Its employees enjoy diplomatic immunity. Its buildings cannot be searched. Its records cannot be subpoenaed. This level of secrecy is not a relic of the past. It is an ongoing reality. By operating beyond national jurisdiction, the BIS exemplifies how modern financial power transcends the boundaries of governments and democratic oversight. In addition to the BIS, global financial institutions like the International Monetary Fund (IMF) and the World Bank play significant roles in shaping the global economic landscape. These organizations provide loans to developing nations, but their conditions often require structural reforms that benefit multinational corporations and financial elites. Privatization of state assets, deregulation of markets, and austerity measures frequently accompany these loans, creating a cycle of dependency. Nations that accept these loans become beholden to conditions set by institutions influenced by elite families. This dynamic explains why, despite vast natural resources and potential, many developing nations remain locked in poverty. Their economies are structured to serve the interest of external powers rather than their own populations. The flow of wealth from poorer nations to wealthier ones is not accidental. It is facilitated by policies and institutions designed to extract value from the global south and channel it to the elite families and corporations that dominate the global economy. When viewed through this lens, the consolidation of wealth among 12 families is not surprising. It is the predictable outcome of a system that rewards control over money creation, debt issuance, and international financial policy. The average person interacts with this system only at the surface level, working, borrowing, saving, and paying taxes. But the families who oversee the system operate at the level of structural control. Their wealth is not tied to labor, but to the architecture of finance itself. Understanding this architecture reveals a critical truth. Global inequality is not the result of individual failure or market inefficiency. It is the consequence of a system deliberately constructed to centralize wealth and power. The remaining question is how the system perpetuates itself across generations and why it remains invisible to most people. The entrance of elite financial control across centuries is not an accident, nor is it simply the result of inherited wealth. It arises from a deliberate strategy of institutional continuity, intermarriage among powerful bloodlines, strategic philanthropy, and the shaping of public perception. While average families build wealth through income and savings, elite families construct and maintain power through systems. These systems operate quietly, invisibly, yet overwhelmingly in their favor. One of the most significant tools of elite continuity is the use of charitable foundations. On the surface, these institutions appear benevolent, designed to advance education, science, health, or social welfare. But historically, foundations have served a dual purpose. They shield vast amounts of wealth from taxation and public scrutiny, while simultaneously shaping academic research, public policy, and cultural narratives. For instance, foundations established by the Rockefeller, Carnegie, and Ford families have exerted profound influence over educational curricula, media organizations, political institutions, and scientific research across the 20th and 21st centuries. Through these foundations, elite families do not merely donate money, they direct the development of entire fields. They influence what universities teach, which studies receive funding, which social reforms gain traction, and which narratives dominate public discourse. When important subjects like financial literacy, political economy, or wealth inequality are minimized or distorted, it is not because educators lack knowledge. It is because the curriculum is shaped by interests that benefit from a financially uninformed public. Beyond philanthropy, elite families strengthen their influence by structuring their wealth in complex corporate arrangements that transcend national boundaries. Multinational conglomerates, holding companies, and private equity firms allow these families to exert control across industries ranging from energy and finance to telecommunications and pharmaceuticals. The actual ownership structures are often opaque, hidden behind layers of shell corporations and trust. This opacity protects their assets from taxation, litigation, and political risk. while enabling them to move capital across borders with ease. Moreover, elite families maintain continuity through strategic alliances forged by marriage. Throughout history, unions among powerful families, financial dynasties, aristocratic houses, corporate empires have consolidated wealth and influence. These alliances are not mere social customs. They are calculated decisions that ensure resources, networks, and institutions remain concentrated rather than dispersed. The continuity of elite power does not depend solely on individual talent, but on preserving the interconnected web of relationships that sustains it. Another critical component of elite durability is control over media and information. While modern audiences often perceive media corporations as independent businesses, many of the world's largest media companies trace their ownership to financial institutions or conglomerates linked to elite families. These institutions influence what stories are amplified, which narratives are suppressed, and how economic events are framed. When financial crises occur, media coverage often emphasizes individual irresponsibility or regulatory failure, avoiding deeper structural critiques that reveal the role of elite manipulation. This control over narrative shapes public perception, maintaining the illusion that the global economy is governed by randomness and merit rather than design. People are encouraged to believe that wealth disparities result from personal choices, rather than centuries-old systems that structurally disadvantage them. This narrative prevents the public from questioning the architecture of the system and shields elite families from scrutiny. It is also essential to understand how elite influence permeates political systems. Although democratic institutions promise representation and accountability, the funding of political campaigns, lobbying efforts, and think tanks enables elite families to shape policy from behind the scenes. They finance candidates, influence legislation, and promote ideologies that align with their interest. As a result, policies that genuinely challenge elite power rarely gain momentum, while reforms that appear progressive often leave the underlying structures intact. This interplay between wealth, politics, and public narrative explains why meaningful change is so difficult. The system's architecture ensures that power flows upward, not outward. When political revolutions occur, they often replace leaders but leave financial structures untouched. As long as money creation, debt issuance, and international policy remain under elite influence, the cycle continues. One might wonder, if this system is so pervasive, why does it remain hidden? The answer lies in its complexity. Modern finance is intentionally opaque. Its language is technical, its mechanisms abstract, and its institutions shielded from public understanding. Terms like quantitative easing, fractional reserve, and derivatives markets obscure the reality that these processes concentrate wealth. Complexity becomes a smokescreen, masking the simplicity of the underlying dynamic. Those who control money creation ultimately control society. This invisibility is the final pillar of elite dominance. Power is most effective when it is least visible. When people do not perceive the system that governs them, they cannot resist it. They blame themselves for financial hardship, attribute success to luck or effort, and accept inequality as an unfortunate byproduct of progress rather than the intentional design of powerful families. To fully understand how deeply embedded this control is, we must now examine the most intricate element of the system, the global mechanism of debt, liquidity, and financial engineering that binds nations and individuals alike. To understand how the modern financial elite preserve their dominance, one must examine the global mechanism of debt creation, liquidity control, and financial engineering that underlies the entire world economy. The system, often presented as a neutral framework, designed to facilitate growth and stability, operates in practice as a strategic apparatus for concentrating wealth and maintaining influence across borders and generations. The complexity of this system fuels its invisibility. Its technical language disguises the simplicity of its underlying effect. Wealth rises upward, losses fall downward, and nations become increasingly dependent on those who control credit. At the core of this mechanism is the principle that money is debt. Every dollar, euro, yen, or pound that enters circulation originates as a loan. Whether issued to governments, corporations, or individuals, money begins its life as a liability, because each loan must be repaid with interest. The system requires continuous borrowing to sustain itself. Without expanding debt, the money supply contracts, economies slow, and financial markets stall. This dynamic ensures that societies remain perpetually reliant on lenders' institutions, often influenced or owned by the same elite families who helped shape the banking system centuries ago. This cycle becomes especially evident when examining government finances today. Nearly every major nation carries significant debt. The United States alone holds over $34 trillion in national debt, a figure that continues to rise with every budget deficit. Japan's debt exceeds to 150% of its GDP, while nations across Europe, Latin America, and Africa face similar pressures. These debts are not merely numbers on a ledger. They are commitments that tie governments to the demands of financial markets. When nations borrow, they become beholden to the entities that purchase their bonds: banks, investment firms, and central banks. Elite families with substantial influence over these institutions indirectly shape national priorities. This reality becomes clear during economic crises. When governments face budget shortfalls, they often turn to international institutions like the IMF for assistance. These institutions lend money under strict conditions, forcing nations to adopt policies that align with the interest of global finance, rather than the well-being of their citizens. Privatization, deregulation, reduced social spending, and the selling of national assets frequently accompany these loans. As a result, domestic wealth flows outward, enriching multinational corporations and financial elites. Another layer of control arises through liquidity management, the ability to influence the availability of money in the system. Central banks play a crucial role here. By adjusting interest rates and engaging in operations such as quantitative easing, they determine how easily banks can lend, how cheaply businesses can borrow, and how quickly economies can grow. When interest rates are low, borrowing increases, boosting consumption and investment. When rates rise, borrowing contracts, slowing the economy and increasing financial stress. The power to manipulate these conditions gives central banks and, by extension, the elites who influence them, a direct hand in steering national economies. In 2008, during the global financial crisis, the Federal Reserve injected over $4 trillion into financial markets to stabilize collapsing institutions. While ordinary citizens lost homes, jobs, and savings, the financial sector rebounded rapidly, posting record profits within a few years. This disparity underscores the moral hazard built into the system. Those who create financial risk often profit from its resolution, while those who absorb the consequences remain vulnerable. The mechanics that enable such bailouts rely heavily on complex financial instruments like derivatives, credit default swaps, and structured debt products. These instruments allow financial institutions to leverage assets far beyond their actual value, amplifying both potential gains and catastrophic losses. Yet even when mismanagement leads to collapse, the system ensures that elite networks retain their influence. After the 2008 crisis, not a single major executive from a leading financial institution faced criminal prosecution, despite widespread evidence of fraud and misconduct. Instead, these institutions emerged even larger due to mergers and government-supported acquisitions. This pattern reveals a stark truth. Financial crises do not threaten elite power. They reinforce it. When markets collapse, governments intervene to protect institutions deemed too big to fail. These institutions often become larger, more interconnected, and more essential to the global economy. Ordinary citizens shoulder the burden through unemployment, inflation, and reduced public services, while elite families continue to benefit from appreciating assets and expanding global influence. The global financial mechanism also relies heavily on currency dominance, particularly the centrality of the US dollar. Since the end of World War II, the dollar has served as the world's primary reserve currency, giving the United States and the financial institutions tied to its economy outsized control over global trade. Oil, commodities, and international loans are denominated in dollars, requiring nations to hold reserves of U.S. currency. This dynamic ensures global demand for dollar-denominated debt, allowing the United States to borrow at exceptionally low cost. It also positions U.S.-based financial elites at the center of global liquidity flows. The system extends further into global banking networks, including organizations like SWIFT, which facilitates international payments, and the BIS, which coordinates central banking policy across more than 60 nations. These networks operate beneath public consciousness but serve as the infrastructure through which elite families maintain influence. While these organizations present themselves as neutral or technocratic, their decision-making processes are shaped by private interest with generational wealth and global reach. The cumulative effect of these mechanisms is profound. They create an economic landscape in which wealth flows upward through interest payments, asset appreciation, and debt servicing. As debt grows and it must grow for the system to survive, so does the influence of those who control money creation. The financial elite become indispensable not because they create value, but because the architecture of money ensures their centrality. They are the gatekeepers of liquidity, the issuers of credit, and the stewards of a global system designed to benefit those at the top. To see how this system perpetuates itself indefinitely, we must now examine its impact on society's political structures. and individual lives, and the final result of allowing a small group of interconnected families to shape the destiny of the entire world. The cumulative impact of centuries of financial engineering, institutional design, and intergenerational wealth transfer has produced a world where economic outcomes are not the result of personal effort or market dynamics alone, but the predictable consequence of a system tilted toward those who sit atop it. The concentration of global wealth among 12 families is not merely a reflection of success. It is evidence of structural dominance. Their influence shapes everything from the cost of borrowing to the flow of international trade, from the direction of public policy to the stability of entire nations. This dominance expresses itself in ways subtle yet profound. For ordinary people, financial life is a constant negotiation with forces they cannot see and do not control. Wages stagnate even as productivity rises. Housing prices surge beyond affordability. Inflation erodes purchasing power. College tuition climbs relentlessly, creating generations burdened by debt before they even enter the workforce. Meanwhile, financial institutions post record profits, executives receive multi-million-dollar bonuses, and elite families watch their wealth multiply through asset appreciation and investment income. The contrast is not accidental. It is the result of a system designed to reward capital over labor, ownership over contribution, and inherited influence over democratic choice. The average person's financial life is constrained by limited access to credit, high interest rates, and systemic volatility. But for elite families, these same dynamics provide opportunity. When interest rates rise, the value of their bond holdings increases. When markets crash, they buy distressed assets at discount prices. When nations fall into debt, they profit from the interest or benefit from the privatization of public assets. Their wealth is protected not by chance but by a global architecture built to preserve it. It is difficult for many to accept that a small group of families can wield such power. Yet history offers countless examples. Monarchies once ruled by birthright, aristocracies governed through land ownership, and empires expanded through conquest. The modern era replaced these overt forms of dominance with a subtler and far more enduring structure: financial control. Instead of armies, elite families use capital. Instead of borders, they use markets. Instead of decrees, they use policy. Their reach spans nations because their power is rooted in the international financial system, itself a system they helped create. One of the most significant consequences of this structure is its effect on democracy. While citizens vote for political leaders, the policies that shape economic reality often originate outside democratic influence. Central banks operate independently of elected officials. International financial institutions impose policies on nations without public consent. Trade agreements are negotiated in secrecy. Lobbyists draft legislation that serves elite interests. In this environment, political power becomes symbolic, while financial power remains substantive. The growing disconnect between political authority and economic control fuels public frustration. People sense that their votes do little to change their material circumstances. They watch as wealth inequality widens and economic mobility declines. They experience financial pressure despite national economic growth. These trends are not the result of individual failure. They are symptoms of a system designed to extract value from the many and deliver it to the few. This raises a crucial question. What happens when a system built on perpetual debt, asset inflation, and elite dominance reaches its limits? Throughout history, periods of extreme inequality have often preceded major social, political, or economic upheavals. Today, global debt levels are at record highs, over $300 trillion worldwide. Asset bubbles have inflated beyond historical norms. The cost of living continues to rise faster than wages. These pressures create instability, and instability threatens the system's ability to function. Yet the financial elite have proven adept at navigating crises. When markets collapse, they are positioned to acquire undervalued assets. When currencies fall, they shift capital to more stable regions. When governments default, they influence restructuring terms. Crises that devastate ordinary citizens often serve as opportunities for elite consolidation. This is one of the system's darkest features. It converts instability into advantage for those who control its mechanisms. If the current trajectory continues, the next global crisis may reshape the world economy in ways few anticipate. Digital currencies controlled by central banks could replace cash, giving financial institutions direct oversight of individual transactions. Automation could eliminate millions of jobs, concentrating wealth further among capital owners. New financial instruments could obscure risk until another collapse occurs. In each scenario, the structure of the system ensures that elite families maintain their position. This final truth is the most unsettling. The system is designed to preserve itself. It adapts to new technologies, new regulations, and new political landscapes. But its core objective remains constant, concentrating economic power in the hands of those who already possess it. As long as money is created through debt, as long as central banks operate beyond democratic reach, and as long as global financial institutions impose policies that prioritize corporate and elite interests, the cycle will continue. Understanding this truth is not an act of cynicism, it is an act of clarity. Once you recognize the architecture of financial power, you are no longer misled by the illusion of economic fairness. You can see the system for what it is and understand why individual effort alone cannot overcome structural barriers. More importantly, you gain the ability to question narratives designed to keep the public compliant. As we conclude this investigation, consider the world you live in not as a random configuration of markets and institutions, but as the product of deliberate design. The question that remains is a profound one. Are we wiser now? Or are we walking the same path in better suits? If this exploration opened your eyes to the hidden architecture of global wealth, share your thoughts in the comments and subscribe for more deep investigations into the systems shaping our lives. Your awareness is the first step toward breaking the cycle of financial illusion and reclaiming the power that has been quietly extracted from the public for centuries.